chair is eating me.
Great, good afternoon. Thanks so much for joining our high performance compute panel. Today I'm joined by Tyler Page, CEO of Cipher Mining, Harry Siddock, Chief Business Officer of CleanSpark, and Paul Prager, co-founder and CEO of TeraWulf. So I guess just to open it up with a fun question, if you could buy one equity within your universe, right, within your sector, that is not your own equity, what would it be and why? Who's doing a good job out there?
I'll take the hot seat and go first and say I'm not going to name anybody on this stage just because we're here, and I think I would probably choose our three names at the top of the list. I think right now the really interesting way to play it is to own something like Constellation, where the energy that sits underneath this is in increasingly high demand. They're becoming more sophisticated and aggressive on the build out of the capacity to drive revenue. We're seeing utilities all over the country invest in the revenue side of their business, not the cost cutting side of their business, for the first time in 30 years. And so I think that risk adjusted, that's a really good place to be.
I go with Google. They own 15% of my company, and I think they'd like it if I own some of them. I think they're cutting edge on the technology side. I think the market's beginning to reflect on that. They're just a brilliant firm, and in negotiating with them, I'm sure Tyler would share this, they're just super impressive, real professional, experts in every way, and have an idea of where we're all should be headed, and they're helping to lead us there.
Yeah, very good.
So this is a great curveball question. I mean, I will say I would probably back anything that Paul or Harry are doing. I've known them for a long time. I also saw someone's launching a 2x levered Cipher note or something like that. So I guess if you really want more juice than you can already handle, feel free to take a look. I would agree with Paul, Google and Amazon. I'm biased also because I've got deals with those two companies. Cipher has deals with those two companies. And I think that they're sitting just sort of at the nexus of everything that's going on in the space. So I'll do a little bit of a cop-out and say that, and maybe say, independent of a stock you could go buy, I can tell you in my PA, I sort of want to go build like housing in West Texas, because I do think the data center capital, the AI data center capital of the universe will be West Texas. And I think there's going to be a lot of well-paid electrical engineers that need places to live in places like Midland. So if you really feel adventurous, maybe I'll give a non-answer answer and say that.
No, I like it. Those are all good answers, gentlemen. So I guess let's delve into it. Execution has become a key industry divider, right? So as you're thinking about delivering an AI-ready data center, what is most important to focus on? And I guess what will be clutch in 26 and 27 to differentiate yourselves from traditional data center providers?
Yeah. I mean, my view is that everything is in the execution. I think the space will have a lot of, there'll be big winners and big losers, and I think what makes that determination is going to be your ability to execute, which is a combination of contracting in the right places, right? So you don't want to come to a contract where you've been too aggressive on schedule or procurement, leave yourself open to tariff risk. You want also to be able to have your labor locked down. I mean, I think part of the thing that makes our sites exciting or less than exciting will be, is there a seasoned and experienced labor crew? Are they credible? And can you hold on to them for a long period of time? It's one of the benefits of our site up at Lake Mariner. We own power plants up there, so we have labor that's almost like family attached to our assets, and that will build out, ultimately a 750 to a gig data center facility at Lake Mariner, 400 megawatts at Cayuga. I think the third and final thing will be transparency. We saw last week somebody else had a hiccup, and there was very little transparency. People were surprised. It's the worst thing in the world when you're surprised by a hiccup, and I think what you have a duty to do is not only be transparent with your shareholders, but mostly to be transparent with your customer,
right?
So that he doesn't get disappointed and ultimately have to disclose something to the market that's going to take us all down. So I think transparency, execution through good contracts and capability, and execution through good handle on the labor pool.
I think to pull on one thread there, but take it in a little bit different direction, is I do agree that particularly in 2026, there's going to be differentiation across the sector. I think right now, it's so early in this, we're 3 companies that are involved in sort of transitioning Bitcoin mining story into an AI HPC story. And I think as that transition happens, we've had kind of sector-wide trades where things go up and down. To Paul's point, execution will start to cause a sort of differentiation among those names because there are real deadlines. It's sort of everything is a series of execution. So the first thing is getting a deal signed. We've had a wave of excitement around those deals being signed. We just signed one this morning, so I'm having a good social media day. The next thing, it will then be delivering financing on all of them. Of course, can you actually support the tremendous amount of money you need to raise, however you're going to do it? And then kind of the final step, broadly speaking, is then actually executing the physical construction and delivering on time such that these leases are cash flowing. And I think the thing is, and this would be true for any of our companies, but once you get to that point, stocks in the sector, assuming you complete those execution hurdles, should have a significant re-rating because you should be taking whatever risk haircut the market is putting on that stream of cash flows off. I think to Paul's point last week with the kind of industry wobble, we saw it. It felt like I was at a conference that was similar to this last week, that most of the questions were now focused. They felt more like the debt investor questions we were getting, which were really around all the risks to schedule, what's up with your labor force, how much of the equipment have you procured, et cetera. So I do think it will be the year of execution in 2026.
I don't disagree with anything either of you said, unsurprisingly. I also, we're the only one on the stage who doesn't have an executed lease right now, so I want to take a zoom out and just talk about the project life cycle dynamics, and that we're in an industry and a sector of an industry where the corporate execution is governed by step functions, not by linearity. And so what I mean by that is that, you go from power contract unsigned to signed. You go from substation unenergized to energized. You go lease signed, unsigned to signed. You go RFS date unachieved to achieved. And then you go live with the lease payments. And so because of the dynamics of each of those project steps, the volatility and read through to the equity valuation is quite significant. And so being able to build not only a shareholder base and a management team that's prepared for that type of step change across project life cycle, but also being able to build pipeline and durable relationships both on the execution side as well as the offtake and tenant side, customer side, that type of full project life cycle and full corporate strategic evolution life cycle is important to have very well understood across your shareholder base, your bondholder base, across your management team, and across the third parties that make your project delivery ultimately successful, both on the leasing side and the construction side. So it's complex and it's chunky, but ultimately once we get from the 0 to 1 phase that I think the last 24 months have largely been, as we get into a more sort of orderly delivery cadence as a sector, I think that the step function dynamics may smooth somewhat.
Just one final point on that. We were the first to go out and take our Google Fluid Stack deal and get it rated by the agencies. We're double B across the board.
Thank you for your service. In more ways than one.
I enabled a great amount of interest and a tighter deal for Tyler, and that's what friendship's all about.
I definitely owe you one.
But what I think is important here is, I've been in the power space for 35 years. I've developed power plant, 5.5 gigs of power, and I can't remember a time when you could go to the rating agencies with development risk and get it done, get it rated double B across the boards. And our deals have development risk in it. There's no doubt about it. So when I think about execution, that is where it's all got to be. Because if we fail, which we won't, he's got a great team, we have a great team, you've got a great team. But if, God forbid, you fail, that's not getting a double B rating next time. And not clear to me all the agencies will even want to rate you, because they will look at that development risk, that construction risk, as too much for them to get comfortable with. So I think we're first out there, but we, more than anyone else, need to truly execute, not only for our customer and our shareholders, but for the business model to be able to continue the path that it's on. Because otherwise, I think the rating agencies and therefore the lenders, they're not going to go there.
Yeah. Let's double click on that a little bit. As you're thinking about these hyperscalers, many times we're seeing initial contracts being followed by second or third order contracts with data center providers. So what do you think about as you're executing on that first contract in order to secure, call it the second and third contracts that might be down the line? And how are you thinking about counterparty risk, right, as you devote a lot of your megawatts to one key player?
So I'll fire at that one, because I've talked about this a lot with our investors, that our company has a pipeline of sites. So we have a few available now. We've got several that are scheduled to energize in the next few years. So when we think about trying to maximize the stock price, the equity holder value in the company, it's really about how do we credentialize ourselves in this HPC space and then project that value across the remaining development pipeline. So what makes us, in investors' eyes, more likely to do deals 4, 5, 6, 7? And so for the first deal, we really did not focus on squeezing every possible dollar out of the lease. And this is related to counterparty and financing. Again, I think of it as once you can get someone to the table, you have two main buckets of risk, which is the financing bucket and then the actual construction and execution bucket. So we really focused on how do we take down any risk with the financing piece. Because to Paul's point, this is, at least the ratings agencies and then obviously investors, kind of first impression on this structure and this deal and how is it going to work. And so in our discussions and in our deal, we have a backstop of the debt amount from Google. And we very much focused in our discussions on maximizing that number so that we could feel the most comfortable that we would finance it successfully. And then the idea has been get one done and credentialize yourself where you're very confident you're going to get the financing done with a great counterparty where people will focus on development risk and not sort of payback risk 5 years, 6 years into the future. And then our philosophy has been to try to drive better terms on successive deals, and we've managed to do that. So we've now done 3 deals. In each deal, the rent has gone higher. Part of that is the marketplace remains very fundamentally sound for what these companies are bringing to the table. Part of it is also building on the first deal and the second deal and getting a second name in there. And now you're no longer having to negotiate terms with a company that's 600 times your market cap because you've got 2 of them. So really, there's another company that is more of an equal size sitting behind you when you negotiate. So that's how we've thought about it. There's sort of a sequencing to it. And in the first deal, it was sort of highest likelihood, best possible counterparties, highest likelihood of financing. And so far, 2 months into it, we're right on that track.
Right. For us, slightly different approach, but again, we've been in the energy infrastructure business for 30-some odd years. So we're not terribly worried about the pipeline because we have an internal pipeline and we have a very skilled team that's been together for 20 years plus just in developing power facilities. So the first customer that we had was G42. World-class credit, UAE sovereign wealth fund credit, Mubadala as backers. And we're pretty excited about that. We'll continue to grow with them. Our next was Google Fluid Stack. And in that, we wanted to really try this structure that now seems to be the norm. We didn't like the original CoreWeave Core Scientific structure because we thought, why would you let a wolf in the chicken coop? You don't want your customer paying your CapEx. It just inherently is not a good idea. So we love the Google Fluid-Stack relationship, and we were focused on, as Tyler indicated, how do we make sure that we have bulletproof financing? We recently announced entering into a JV with Google Fluid-Stack in Abernathy, Texas. We did not own the site, so we were not part of the program that went there. But it was the same group of guys and gals in the Abernathy deal, such that when they got into it, they called up and said, you know, we'd like you to come in and take a 51% interest in the deal. And I guess, because this goes to your question about how do you feel about counterparties, you know, we believe on our own sites, we will have a long-term relationship with Google Fluid-Stack and the end user. We believe the same of G42. But when Google calls you up and said, hey, we'd like you to come into this deal, we've already got the site, we've got an EPC, but we want you to come in, you don't say no to Google. You say yes to Google. And you've got to find a way to say yes to them that is also good for your shareholders. So what we did was, we said we'll do it, but anything else that comes out of that site, we're in. And your next site, we're in. So that we could get comfortable that it was a slightly lower return deal relative to our owned sites. And that spread is because we don't have ground lease and the Abernathy site did. And we said, but we'll do more of it. So from my perspective, like Tyler, we have two great customers. And in the Google Fluid-Stack relationship, there are really 4 potential customers. So I'm pretty happy with the universe of customers. And now our priority is on executing what we've got, and maybe looking at sites with a little bit more regional diversity. I don't want to own a West Texas housing development.
I love hearing this from you guys. I think we're a little earlier in our journey than you guys are, but we, like with everything, came kind of energy first. We are the largest consumer of power in MEAG in Georgia, and so there was some inbound that we saw in that region that came from, you know, the normal roster of people who can take down multi-tens of billions of dollars of data centers. And they, you know, they really like the regional approach, to your point. We followed that up with an acquisition of 285 megawatts in the greater Houston area. We think that there's just going to be more demand for this stuff than there is readily available electrons over the kind of cadence that they're expecting it. And so I think about this more from a market perspective, that there's 3 tiers here. There's the demand profile for this type of clustered compute. There's the energy availability that can meet that demand. There's less energy than there is demand. And then there's even less execution than there is energy. And so as you move down that funnel, that's where the opportunity for value creation is. I think that when you live in between execution and energy, you're really sitting on the back of getting that bulletproof credit, getting the high quality GC and labor counterparts to do the execution with you. It's part of why we love the Georgia market, is that we've basically rolled the same crews all over Georgia and Tennessee for the last 3 years. And so they're ready to continue to go the distance with us. But I think understanding that dynamic between demand, energy, and execution is where the winners and the losers from the sector are going to emerge. And that's true when you go to the end customer use case. It's who has the demand and who can locate the power. And then on the developer side, which is where all 3 of us sit, it's who can marry the right energy profile to the right execution, deliver on time and on budget, and make for a happy customer. Because what's great is that the duration of these contracts is really significant and highly accretive to shareholders, and the repeatability of this business model is so significant, you know, as we look out more of like a half decade to a decade from here. And like with anything, you know, I think of the energy generation business as the perfect corollary, which is that when you build a new generation asset type for the first time, a new technology for the first time, there's all the question marks in the world. The cost looks high, the levelized cost doesn't quite make sense. But once you get to a 1 of n, so you have that repeatable throughput line, you're able to get to a normalized, scaled, supply chain driven unit economic profile. and the return profile becomes very digestible and well understood, especially to the institutional investment community, and you get to a very happy kind of cadence with them where they have clear visibility, we're able to deliver clear transparency, execution is mitigated, and the risk profile is just more deeply understood.
Yeah, no, it seems right. I mean, execution is paramount, especially in these early stages of the expansion into HPC. You know, Tyler touched on something in his response that maybe we should drill down into. You talked about pricing improving steadily over the course of the past year or so. I guess, do you believe that we're still in the early stages of price discovery, and kind of how will pricing perhaps evolve over the course of the next year or so?
So I think we're in the nascent stage of the industry. So it's evolving tremendously. So the real issue is, do you have electrons on site ready to roll? And the answer is no. There's a massive shortage. You know, Stephen Bird says we're 50 gigs short. I don't know what the number is, but the demand for what we have has been ever present since April, May, and it's not going away. I see many different things happening in the industry away from what we can control. You know, AEP sent a letter out last week to some folks in Central Ohio. Said if you're in the queue for 26, you're still in the queue, but think more 29, 30. And if you're in the queue, by the way, for every 100 megawatts to hold your queue position, we want $30 million. That's a big change. So that will take out a lot of the real estate guys and their firstborn sons who all think they have a data center site. You've got 85 gigs of supply in ERCOT. You got 281 in the queue. Please, right? You've got PJM now reevaluating the business, and then President Trump, who has made a massive positive effect on our industry. You know, he's just been great for the business. You know, he's basically said, if you want to expedite a queue connection, an interconnect, bring generation. So now I think everybody's figuring out, okay, how am I going to do that? And maybe next year we're on stage talking about, well, we're doing an island generation deal. You know, I think Oracle was looking at an island generation deal in New Mexico. It was $17 billion. And there was no transmission out to the site. And so the lenders who were previewing the opportunity were like, okay, what happens if Oracle changes its mind? They don't want to do the offtake. What am I doing with the electrons? You got no transmission. And when you say, oh, we'll build it, well, you can't because it's regulated. So I think the business is just changing so much that I can't tell you how that will affect the price action. I think on a case-by-case basis, location by location, and the different variables that you're bringing to the table to make your site compelling to that world-class credit, I think that's what it's all about. But I think it's literally step-by-step, plant-by-plant, site-by-site.
I'll give a little bit of a dynamic that I think we've seen trying to read the tea leaves in our discussions with hyperscalers is how I think about the price discovery phase we're in. So I think that they are very sharp at projecting the growth of the traditional cloud data center piece of their business. They can be very disciplined, they have a very good forecast for that, and a lot of the megawatts that they have aligned in their own pipelines in-house kind of match that expected growth out for the next 3 or 4 years, and they've got it dialed in pretty well. I think the reason we see this kind of feast or famine wave it really comes from the AI side, which is so new, they're not as good at forecasting it. And I think simultaneously, obviously we have dynamics going on where there's these various strategic deals around the industry where often, again, I'm just speculating, but I'm guessing, you know, a lot of what they're bringing to the table if they're making an investment in an LLM or something is, hey, we can bring a lot of the power for you, and obviously they can help with various backing and financing, et cetera. And so with those deals and with the inability to forecast this very chunky, fast growth in what this race is around LLMs in particular, that's created this dynamic where it's sort of like, we used to be disciplined around price, but if you have electrons available in the next 2 years, we could sacrifice a lot of that discipline. And I think that's where, again, what we've seen just having signed 3 deals in the last couple months and with a steadily increase in price, and when we, at least early days, look at the kind of talk around the sites we have available in the next 2 years, that price direction continues to go up in discussions. Again, industry changes quick and you don't have anything done until you're signed. But I think that piece of price discovery is very live, and it's related to the inability to forecast with reliability the sort of AI HPC demand. And the one thing I'd add to that that's just a dynamic that's interesting to watch is the last 2 years, I have just a sneaking suspicion that like internally at these firms, they all get together in the summer and try to forecast out 2 years. Because if you look at this summer and the summer before, it was kind of coming out of the late summer that suddenly 2 years or a year and a half ago, a bunch of those names were throwing LOIs on everything because suddenly they had all this demand. And then remember some of the stories like late last year where, maybe Microsoft's pulling back from some of that. And of course, it also kind of aligned with OpenAI, aligning with some other people to source some of their megawatts. And so that dynamic happened at the end of last summer. And then this summer, you've sort of seen the same thing. You've seen these continued strategic deals. And I can tell you this wave of excitement and frenzy around give us the site and week over week willingness to pay more has really come out of the summer. And this sort of underlies one of our strategic theses right now that we're telling investors, which is we've got some really big sites lined up for 2028. And we're in some exploratory discussions around that, but sort of the industry narrative right now is, well, 26 and 27 is all that matters. 28, there's a glut. And that might be right. I don't think so. I'll take the other side that I have a feeling in a few months, suddenly it's like within the planning scope, and I believe those megawatts will be in high demand.
Yeah.
But anyway, that's kind of, I think we're still early, and the direction continues to go up in price given that demand.
I think that's a great segue into what will be probably our last question, which is, if you were to fast forward 2 years to the end of 2027, what key metric would you call it brag about the most? What are you most focused on accomplishing over that 2-year period for all of you?
Harry, you want to fire? I feel like we stole some of your time there.
Yeah, first time for everything. No, I think that if you fast forward, one is that we'll join the ranks of highly proven operators over the course of the next 2 years. When we come full force, and we commit the entire firm to the strategic direction that we've set our minds to. But I think that what I think we'll be really proud of 2 years down the road is not just delivering on the best possible pricing that we can achieve, but also really pushing the edge of what terms can look like. I think duration is still an open question. I think strategic incentive alignment is still in its early days, and our goal is to carry the torch pretty far forward on both of those pieces as we look to come to market very aggressively with our portfolio.
So, I'm the old guy on stage here, so I'll just tell you, I like to keep it simple. I just want to wash, rinse, and repeat. I think we're at 598 megawatts of contracted revenue. And for me, everything is about contracted revenues, because I think to properly diligence everybody's pipeline is, that's an exercise in futility and a lot of hope. And what I'd rather do is really focus on site by site, execution, get your long-term offtake, get your build sorted out, buy down your procurement schedule, lock in great financing, and execute. And I just want to do that over and over again. We were all started out in some regards in Bitcoin at various levels of excitement about it. I would argue I was the least excited by Bitcoin. But that was for 2 reasons. One is I was an old guy in the power space. And so what I used to like to do is build power plants, get a long-term offtake, finance them, and go on to the next. And when the power market started moving to a spot market, the market would be flying, and everybody would say, Prager, you must be killing it. And I'd say, no, we're doing okay. And when the market was, crapping in bed, everybody would look at me and say, oh, you must be miserable. And I'd say, no, we're just fine. With Bitcoin, I felt, I couldn't handle the volatility. I couldn't handle, I had no idea where it was going. And so it wasn't fun for me. For me, boredom is fun. And so I just want to do data facility after data facility, get better and better and better at execution, and execute the heck out of it and do it over and over again so that I have maybe an additional customer, more regional diversity in my data centers. Because one of my concerns about data centers is if we're all in West Texas, then you're an easy security risk. And I like the notion of a regional layout of data center facilities. I guess I'm an old Annapolis guy.
You are a Bitcoiner. That's decentralization.
And I'm a Navy guy, and I know that I like to have redundancy from a regional perspective. So as long as we have a bunch of those projects and they're up and operating and generating revenue, and I could argue with my investors that I should be trading at a REIT multiple, that's my goal.
Yeah.
Critical IT megawatts under contract that are cash flowing, KPI number 1. Critical IT megawatts under construction/development, number 2. And then the last one would be a measure of how well we recycle and refinance the capital from the original deals. Because we should be in a place that we can refi at extraordinarily low rates with the tenants we have in AWS and Google, such that that sources the equity for the deals in our future pipeline.
All great answers. Gentlemen, thank you for joining us on this panel today, for coming to our conference, and thank you.
Thank you, Brian.
Thank you, Brian.
I'm sick, so I'll go like this. Well done. I want you to-